That was different. Okay, so we are learning about inventory this week. We know a bit about inventory, right? It's come up before, but this is going to be a deep dive into how to keep track of your inventory costs. And it gets a little tricky because you've got not only periodic and perpetual methods, which we're familiar with, right? Those terms, yeah. But we also have 4 options within each of those 2 methods. So that gives you a total of 8 different ways to do inventory. And just take good notes, follow the steps, and let me know if you have questions. All right, so really what the whole chapter is about is the costs of inventory. How do we calculate the cost of our inventory? How do we value our inventory? And it's important because that impacts the cost of the goods that we sold, because what we sold was inventory, right? And it also impacts the cost of any ending inventory that did not get sold. So the periodic method, as you know, is where you wait till the end of the period to figure out the cost of your inventory. And with the perpetual method, every time you make a sale, you record the cost of the inventory at that time. We'll see what happens if there's a mistake on the income statement or balance sheet related to your inventory, and then how that gets corrected. And then we have some new ratios, which are very similar to not last week because we were on break, but the week before, chapter 9, we learned the accounts receivable turnover ratio. Do you remember that? Well, the inventory turnover ratio is almost exactly the same. And then there's a number of days sales and inventory, which is very similar to the number of days sales and accounts receivable. So those ratios shouldn't be difficult once we get to them. So why is it so important to keep track of your inventory costs? Well, imagine how many products some companies have. You walk into a grocery store, a large grocery store, there might be 40,000 different products in that store. That's a lot of inventory, right? And the costs are constantly changing, right? Suppliers change their costs, companies renegotiate. So that's a lot to keep track of. It's for merchandising companies and manufacturing companies, inventory is one of their major costs. The purchases don't always happen at regular times. So you might one month order some inventory from a supplier and then next month you don't. So every time you make that order, you have to keep track of what those costs were because they could be changing, right? Suppliers have the right to change their prices. The products you sell are also at different prices, and oftentimes those prices are based on the cost of the inventory because companies want to sell their products for more than what it costs them, because that's how you make a profit, right? And then how much inventory you purchase is based on how much you expect to sell. When you take managerial accounting, if you take that course, there's a whole chapter on budgeting. In the budgeting process, you always start with your sales, because how do you know how much you need to produce unless you know how much you plan to sell, right? So you always start there and then figure out how much inventory you need. So here we see the impact of inventory on both the balance sheet and the income statement. On the balance sheet, we know that inventory is an asset, right? Something that we own, it has value, so it's an asset. When we sell that inventory, it's no longer an asset. Who remembers what it becomes once we sell inventory? It goes from being an asset to being what? Expense. An expense. Very good. Thank you, Jose. That's right. And that expense is called the cost of goods sold. So whatever was the cost of that inventory, well, it was an asset. Once we sell it, it's now an expense called the cost of goods sold, which, as you see, shows up on the income statement. So having, I was going to say the right price, not necessarily the right price, but having a price for your inventory or a cost is necessary so you know what to put on the balance sheet and what to put on the income statement. We'll get more into the strategy of deciding what's the best cost. Do you want to go with the lowest cost for your inventory? Do you want to go with the highest cost or something in the middle? And it kind of depends on your company's strategy. So we'll talk about that later. All right, so here we'll see one of the basic concepts for this chapter. Tell me if this formula looks familiar. I think we've seen similar formulas in the past. If you take your beginning inventory, let's say you had 50 units of inventory at the beginning of the period, and then you purchased another 20 units. You now have 70 units of inventory, right? So your beginning plus whatever you purchased is the total amount of goods that you had available. Then if you subtract out whatever's left at the end of the period, that tells you how many units you sold. Or you could switch these last two around. You could take the goods that were available for sale, 70 units, subtract the goods that you sold, which were 52, and that means you have 18 in ending inventory. Okay? That's a really important concept for this whole chapter. That your goods available for sale is equal to the ending inventory and the goods that were sold. Now, if we take each of those numbers of units and multiply by the cost of the inventory, then we can see the cost of our inventory at each of those stages. In this case, the inventory cost did not change. The inventory that we had at the beginning of the period was $7 per unit. The inventory we purchased in February was also $7 per unit. And the inventory that was left over was also $7 per unit. So we would just multiply each of these numbers by $7 to get a total. So we see we started with $350 worth of inventory. We bought another $140 worth. Then we had $126 worth left over. That means the cost of what we sold is $364. That formula you're going to see over and over in this chapter. Okay, both the units and the costs. But you see, this one was pretty simple because the inventory cost stayed the same, right? What if this purchase made in February was at $8? Well, then this is going to be a different amount. And then the ending inventory that was left over, was that from the $7 inventory or was that from the $8 inventory? And that's where it depends which method you use to figure out your inventory cost. Do you go with the oldest cost or do you go with the newest cost? That's what this whole chapter is about. Are there any questions so far? All right, so this is kind of just a reminder when we journalize our sales, are these sales or purchases? Purchases, excuse me. When we journalize our purchases, if we're using the perpetual method, we debit either merchandise inventory or maybe just inventory. But with the periodic method, remember, it's a debit to purchases. Okay, so that's a little confusing, right? You might have to refer back to your notes if you have some journal entries involving purchases. And then pay attention to, are we using periodic or perpetual inventory method? And then when we make a sale, it's going to be a debit to accounts receivable or cash, depending on whether the customer paid us, a credit to sales, or sometimes you'll see it listed as sales merchandise. But it's the same whether you're using the perpetual or periodic methods, right? But the difference is with perpetual, you record the cost of the inventory. And with periodic, you don't. Not until the end of the period, right? Okay, so you knew that already. That's just a reminder. So here are the 4 different methods I alluded to earlier. Within both periodic and perpetual, we've got these 4 options. Specific identification, meaning when you sell some inventory, whatever was the cost of that specific inventory is what you put as the cost associated with that sale. That's the only case where we're using the actual cost of the inventory for that particular sale. In the other 3 methods, it doesn't matter. You know, this is okay. Let me give you an example as a better way to explain it. Imagine I'm selling these antibacterial wipes here, okay? And last month I had 100 of these left over. This month I bought some more. In fact, maybe I made 2 separate purchases of more of these to sell to my customers. It's been all semester, I guess, probably. But if the cost had changed every time, so last month when I bought these, I paid, let's just say $7. And then the first purchase I made this month, maybe I paid $8 per unit. And then with my most recent purchase, maybe I paid $9 per unit. And the customer comes in and he buys one. If we're using FIFO, LIFO, or weighted average, it doesn't matter which one I give him because it's all the same product. So I could take this one, I could take one from over there. It doesn't really matter. The way I'm going to determine the cost is not what I paid for this actual unit. If I'm using FIFO, I'll go with the oldest cost, the first inventory I bought from last month, which was $7 per unit. If I'm going with LIFO, I take the last cost, the $9 per unit. And if I'm using the weighted average method, that's a little tricky because now I have to figure out the total cost of all the inventory divided by the total number of units to come up with an average. But my point is, in all 3 of those cases, I'm just pulling a unit of inventory, giving it to the customer, and it doesn't matter whether it was purchased last month or this month, because the cost I'm basing on the method, not the actual unit. Okay? Any questions so far? All right. So we have examples. All right, so this company sells these GPS tracking devices. That reminds me, I just was reading an article that people from, I think it was Maine, it was some state up in the Northeast, when they're going over to Canada with their vehicles, when they come back, some of them are finding these tracking devices, these Apple AirTags, have been put on their cars. And apparently thieves are doing this so that if it's like a high value car, they can track where it is, and then they'll go steal the car. Neat, huh? But anyways, that just reminded me of that. But anyway, so this company sells some kind of GPS tracking device. Okay. We see they had some inventory at the beginning of the month, so that's whatever was left over from last month. They had 150 units of their GPS trackers, and those units cost the company $21 each. That was the cost. They make a sale on July 5th. They sell 120 units. Here's the sales price. That's what gets charged to the customer. But what we're concerned about in this chapter is mostly the cost, not the price. What does it cost the company? Well, at this point, all of their previous inventory was $21 per unit, right? But if we're using the periodic method, we're waiting until the end of the period to figure out what the cost was. So with the periodic method, you could say the 120 that we sold came out of this purchase, which was $33 per unit. Or you could say that the 120 that were sold came out of this purchase, which was 27. So again, it's not based on which actual units got sold. If you're using FIFO, LIFO, or the weighted average method, it's just based on the method that you use to assign costs to what got sold. So then they made another purchase at $27 a unit. They made another sale. They make another purchase at $33 a unit. And this is how many units they have left over. So let's say you wanted to figure out the cost of the inventory that was left over. It would depend which of those methods you're using. It would depend on if you're using any of those four methods. All right, so let's see. Let's start with the specific identification method. That, as I said, that's the only case where the unit that you sold, you're actually using that unit's cost. So in that case, you're having to pay attention and say, okay, a customer just bought one of these, whatever, containers. Did I take it out of that first batch? Or actually the term that gets used in the chapter is lot. Did I take it out of that first lot of inventory? Did I take it out of the next one that was purchased, or did I take it out of the most recent one? And then you assign the cost based on the actual lot that it came out of, if you're using this specific identification method. So here, they sold one of these GPS trackers, and it came out of lot 2. So what that means, we can see this company has 3 lots of inventory. Lot 1 would be the oldest one. Lot 2 would be the next oldest, and lot 3 would be the most recent. And since this item, this unit that they sold, came out of lot 2, and lot 2 had a cost of $27 per unit, that is the cost we will assign to this GPS tracker. Okay? So then to figure out what kind of profit they made from the sale, take the sales revenue, that's what they charge the customer, right? Minus the cost, which we identified specifically from this lot. And that is our gross margin, our profit for that one sale. So that's, from an accounting standpoint, that's kind of easy. The challenge would be tracking which lot each unit really came out of. Because you can imagine how much things get moved around in stores and having to remember, you know, if you've got 100 of these floating around, which ones were $27, which ones were $21, right? It would be hard to keep track of unless you had some automated system that knew that, like, you know, with the barcode scan, where it not only knew the price, but it knew the cost of that inventory. That's possible, but if you had to track that manually, it would be complicated. Okay, is this sort of making sense so far? Any questions? Okay, well, let's say that the company instead is using the FIFO method instead of specific identification. So with FIFO, whenever they make a sale, they're going to go with the cost of the oldest inventory. FIFO stands for first in, first out. So whenever you make a sale, it's always going to come out of your oldest lot until you've sold all of those units. And again, remember, the inventory might actually be coming from different lots, but we don't care. From an accounting standpoint, we're treating it as if it's coming from lot 1, even if that unit came out of lot 2 or lot 3. So that means with the FIFO method, the cost of that inventory is going to be $21. When we subtract that from the sales price, that gives us our gross profit. Now, in this case, we see that with each lot, the cost went up. And that's typically what happens. I mean, we tend to have more inflation than we have deflation. Prices tend to go up. So if your costs are changing, chances are they're getting higher. But that's not always the case. There could be situations where, for whatever reason, your costs are going down. That's where strategy starts to get involved. If you go with the lowest cost, that's going to make you the highest profit, right? And if you were to use the highest cost, that would give you the lowest profit. Now, obviously, there are some advantages to having a high profit, right? I think we've talked about this before. What are some reasons you would want to be more profitable? As a company?
Make more profit,
Make more profit, yeah.
have more value,
More value, okay. And what does that do for you as a company?
more investors.
Okay, you're more likely to attract investors if you're more profitable. And what else? You need to borrow money. It's also going to be easier if you're more profitable. Let's say you wanted to expand your operations and you go to a bank, the more profit you have, the more likely they are to lend you money. Or if you wanted to sell bonds, the more likely you could sell bonds and raise money that way. So those are, the advantages to being profitable. Bigger bonuses for the executives, more opportunity to grow, right? I mean, that's pretty much the goal, is to be profitable. But we know that in some cases, companies like to make themselves look less profitable. What would be the reason they would do that? Less income tax, that's right. So you see how you could, if you can choose which method, and you do get to choose which method as an accounting department, do you want to use LIFO, FIFO, weighted average, or specific identification? By making that choice, you can make your company look more profitable or less profitable, at least temporarily. I mean, eventually it all is going to wash out. If you make yourself look less profitable, you're just shifting those profits into a future period. But at least for the current period, you could make yourself look more or less profitable, depending on what your strategy is. Okay, so we've seen the specific identification, we've seen the FIFO method. Here's LIFO, and LIFO is last in, first out. So that means every time you make a sale, you go with the last lot of inventory, the most recent lot that you purchased. And you would use that cost until you sold 210 units. Again, it doesn't matter which lot those units came out of. You're always just going to go by these costs. And again, since prices are going up, this would give us the highest cost and the lowest profit. Then we get to weighted average. Now, this is the one that takes the most calculation to come up with, because what you have to do is say, okay, we had 150 units at $21 each. So we multiply to get the total cost of that lot. You have to multiply to get the cost of this lot, multiply to get the cost of that lot, add it all together. Now you know the total cost of all your inventory, right? So you have to multiply each of these lots, add all the costs together, divide that by the total number of units. That gives you your average cost per unit. And we will be doing that later on. Here's an example of it. You see the multiplication for each of those three lots, and then divided by the total number of units. Now, if you go with the weighted average method, that's always going to be somewhere between FIFO and LIFO, because that's how averages work, right? If costs are going up, as we saw here, right? They're going up from 21 to 27 to 33. So if costs are going up, FIFO is always going to give you the lowest cost, LIFO is always going to give you the highest cost, and weighted average is always going to be somewhere in the middle. That's how math works, right? So those are the four methods that, again, can be used with both periodic and perpetual. Any questions so far? All right. So if we look at all four of those options, again, the sales price is the same. In each case, we sold one unit for $36, but the cost varied. Again, with FIFO having the lowest cost, LIFO having the highest, weighted average in the middle, and the specific identification just depends on which lot that unit got sold out of. And we can see a pretty wide range of costs, of profits, right? Anywhere from $3 profit to $15 profit on that one unit. That's a pretty big range. Okay, so there is an accounting stuff video on FIFO. So want to watch that later and get a better understanding of how FIFO works, you can do that. So here it says that you're the assistant controller for a retail store. The company uses manual periodic inventory update. Okay? So manual meaning it's not an automated process. Periodic means at the end of the period, which could be every month, every quarter, every year, whatever period your company decides on, you have to go through and count all the inventory. And only then do you know the cost of the inventory that you have, and that's when you can figure out the cost of the inventory that you sold. So should the company switch to a computerized system that keeps track of the inventory cost with every sale? What would be the benefits of making that change? How would perpetual inventory that's automated be better than manual periodic? Those words. Okay. The automation would mean it's less work. Now, you would probably still, at the end of the period, want to count your inventory just to double check and make sure the automated system is accurate. Because what if somebody slips some inventory out the back door and the automated system didn't know that? We want to know we're missing some inventory. But it would in general be less work because of the automation. Automation, is that right? Yeah, right. It doesn't sound like a
Legal automation.
Automation? Yeah, automation. Okay. Sorry. So it would be less work because of the automation or automation if you prefer. And there's another benefit, which is that you know the cost of your inventory at all times. You don't have to wait till the end of the period to figure out how much inventory you have and how much you sold. You just know every moment because the computer is keeping track of that. So what would be the downside? Why is it that some companies haven't made that switch? Why might there be some companies that are still calculating their inventory cost manually, waiting till the end of the period, instead of installing a computerized system to do it for them? Well, it could be, but I think there's a bigger reason. Cost. You got to buy the hardware and the software and the scanners and whatever it is that's going to automate that process for you, right? And there's a cost to doing that. And if you're a small company, like some small boutique or any kind of little mom and pop shop, you might not have the money to invest thousands or tens of thousands into some inventory management system. But I would say most, mid to large size companies have very automated inventory processes. Okay, so let's look at a specific example here. Now, this is all periodic method. So we're assuming we're at the end of a period, we're looking back and figuring out what our costs were. So this is our GPS trackers again. Here's our data. And we're gonna start with specific identification. And now it's not just one unit that was sold. Now we've got 300 units that have been sold. Okay? So we sold 120 units that came out of lot one. Now that matters because we're doing specific identification. With that method, you would have to say, okay, lot one, that's the oldest inventory that we have, at a cost of $21. So those 120 units were $21 each. Then we make another sale. We sell 180 units. But with the second sale, they didn't all come from the same lot. 20 came from lot one. So that means there's 140 total that came out of lot one, and we can see that down here. 140 units at $21 each is the total cost of what we sold out of the first lot. But then the other 160 units came out of lot two, and that one had a cost of $27 per unit. So here we see the 160 units out of lot two times $27. We add that all up, and we get the total cost of what we sold. Okay? Does that make sense so far? So then if we want to see the cost of what we still have in inventory, do we have anything left in lot one? We started with 150 units, we sold 120, then we sold another 20. So what do we have left over? 10. So we still have 10 units in lot one, which were $21 each. How about in the second lot? How many units do we have left over? So we sold 160 out of lot two, and there were 225, right? So 225 minus the 160 we sold gives us 65 left over. Those cost $27 each. Did we sell anything out of lot three? No. So lot three had 210 units at $33 each. Okay, so then we can multiply each of these lots to get a total, and that's the cost of what's still left over in our ending inventory. A lot of calculations, but hopefully it kind of makes sense for figuring out the cost of what we sold and the cost of what we didn't sell. Ending inventory, right? Okay, so this is how we would use the specific identification method. Any questions on this one? All right. Oh, so here, I forgot. This is summarized nicely here. So this was how many units are left over. Same thing that we calculated right here, our ending inventory, came to 8,895, right? So we see that 8,895. So if we subtract that ending inventory cost from the total goods that were available, that tells us cost of goods sold. Or we could calculate cost of goods sold like this. So you really only need one or the other. If you know your cost of goods sold, you can figure out the cost of your ending inventory, and the other way around. If you know the cost of your ending inventory, you can figure out cost of goods sold just by subtracting from the total cost. Now, how would we get the total cost? Again, we'd have to take 150 units times 21 plus 225 times 27 plus 210 times 33 to know the total cost of all the inventory. Okay. So it ties back into that formula I told you earlier. Your beginning inventory plus whatever you purchased gives you your goods available, minus ending inventory gives you cost of goods sold, or goods available minus cost of goods sold gives you ending inventory. Okay, so that formula comes in really handy in this chapter. Once we know our cost of goods sold, if we subtract that from our total sales, we get our gross profit margin. Same thing we saw when we were looking at one unit, it's just now this is based on many units. Now let's think about how would we get our total sales? Kind of similar. We'd have to look back and see we sold 120 units at a price of $36 and we sold 180 units at a price of $39. So we'd have to multiply them separately, add them together, and that would give us our total sales revenue. Okay, so it takes a little getting used to thinking about this inventory, right? Because you're dealing with multiple lots, multiple sales, different costs, different sales prices, but you know, that's real life. That's how things are out in the real world. So this was FIFO, right? Oh, specific identification. So any questions? Let's look at the FIFO example. Here we also sold 300 units. But with FIFO, it doesn't matter which lots they came out of, right? Because remember, we're doing periodic inventory so far. We'll get to perpetual later. I don't know which one you will like less. They're both a little complicated, they're just different. So that'll come later. But right now we're doing periodic. So we're at the end of the period, we're looking back, and we're applying the costs, not based on which lots the units actually came out of, but just based on FIFO. And with FIFO, it's first in, first out. So these 300 units, we would first take the 150 from lot 1, because that was the first lot. And then we would take 150 from lot 2 and use that $27 cost. So how many units are remaining in lot 2? What was that? 75? If we had 225 and we use 150 of those, again, we're not talking about the actual units, we're just talking about using their costs, right? That leaves us 75 remaining, and we haven't touched lot 3. So the ending inventory would be 75 units still that we have in lot 2, 27, and all 210 times 33, which we can see right here. 75 times 27, 210 times 33. That gives us our total cost of our ending inventory. Again, we can subtract that from the goods available, and that gives us our cost of goods sold. We see it right here too. So this is the ending inventory calculation that I just showed you. And this is the cost of goods calculation. So we took 150 units at $21 each, 150 at 27. That's another way to get your cost of goods sold. Right? So this is FIFO. Again, you can take your cost of goods sold out of your sales, you get your gross profit margin. That's really what this whole thing is about, right? Companies trying to figure out how profitable it is. Okay, now if we do LIFO, well, then we're going to start with the last batch. If we sold 300 units, we're first going to take the cost from these 210 at $33 each. And then the remaining 90 units at $27 each. So that's going to give us this cost of goods sold. How many units would we have remaining in lot 1 in this case? Yeah, 150. We didn't sell any of those, right? Or at least we didn't use those costs. How many units do we have remaining in lot 2? 135. Exactly, 135. So it was 225. We used 90 of those. That gives us 135 remaining at $27 each. Okay. Add it up, we get our ending inventory. Same thing here. Take the ending inventory costs away from your goods available, and you get your cost of goods sold. Subtract that from your sales, you get your gross profit margin. So LIFO, again, when prices are going up, LIFO is going to give you the biggest costs and the smallest profit. Okay, then we have the weighted average method. Again, we sold 300 units. But now what we're going to have to do is figure out the total cost of all of our units, divide it by the total number of units, and that'll give us an average cost. So let's see. There were 585 units. We sold 300. 285 are in ending inventory. But let's see, where did we get this cost from, this average cost? Oh, they didn't show it here. That's weird. Okay, well, let's think about it. Okay, how would we figure out the average cost per unit based on the information that's provided to us? We use the total cost of all the inventory and divide it by the total number of units, and that'll give us an average.
You multiply the units by the cost of each slot, and then you have us together and divide it by the number of units you have for.
Right, so if, like back here where they broke it down for us, we would be multiplying 150 times 21, 225 times 27, 210 times 33, and we would add those three totals together to get the total cost of all the inventory, right? The way they broke it down here, they gave us the total cost of our beginning inventory and the total cost of what we purchased. So this 16,155 is the total cost of all the inventory. So that'd be another way to get that number. And then divide it by the total number of units. If we look back, you add up 150 plus 225 plus 210, that's where they get the total number of units. And as Lewis said, once you take the total cost, divide by the total number of units, that gets you your average cost. Then what we would do is say, let's see, this would be ending inventory of 285 units times that average cost. So now we know the cost of ending inventory. Subtract that from goods available, we get our cost of goods sold. Or to get our cost of goods sold, we could take that same average and multiply it by the 300 units that we sold. Right? So 300 times 2762 would give us this cost of goods sold. So, as you see, they all use the same concepts, right? There's just some slight differences between these different methods. All right. Oh, we're already into perpetual. So, what questions do you have at this point? What are the 4 different methods that we can use within the periodic approach to calculate the cost of our inventory? What were these 4 methods we just looked at? Danielle?
Specific identification,
Okay.
first in, first out.
Yep.
Last in, first out. Weighted average.
Okay, those are the 4 methods, right? Now those 4 methods apply to perpetual as well. The approach that we use is different though, because it's now not at the end of the period looking back, trying to figure out what the costs are. Now we're doing it as time goes on, right? With every sale, we're having to figure out the costs. We can move ahead. We can start to go into perpetual. I just want to make sure you all are up for that. You don't have any questions at this point about periodic. Are there any questions?
Because he switched the method without getting in trouble.
What was the first part of the question?
How many times can you switch the method without getting in trouble?
How many times? Well, you would want to use the same method for an entire year. It is a good question, and I don't know the answer. I would think that in general, you'd probably want to keep the same method for multiple years. Because otherwise it kind of looks like you're trying to hide something or, trick your investors or something. But if a company is doing FIFO and then it decides, you know what, let's switch and do a different method. They have that right under GAAP to do it. At what point are the investors or analysts or regulators going to start to say, hey, you're doing it too often? I don't know. It's a good question. Right. Any other questions at this point? Okay, well, let's look at perpetual. So here we've got the same data, right? Looks exactly the same as what we saw before. But now we're using the perpetual method. And we're doing specific identification to start with. Okay, I'm going to zoom in so you can see this better. And this is not that difficult to read, but it does take a little getting used to. Okay, that doesn't quite fit the way I want it. Okay, that fits pretty well. This is how you track your inventory costs using the perpetual method. It's pretty similar whether you're doing specific identification, FIFO or LIFO. Weighted average is a little bit different. We'll get to that one later. But if you take a look, we've got 3 sets of columns: cost of goods purchased, cost of goods sold, and then cost of inventory that's remaining. Okay? And in each of those 3 sets, we've got the number of units, the cost per unit, and then the total cost. So even though it looks like a whole mess of information, it's actually pretty simple to use once you get used to it. Okay, now remember, we're now doing the perpetual inventory method and we're doing specific identification. So at the beginning of the period, the company had 150 units that it had paid $21 for per unit. If you multiply 150 times 21, you get this total cost. So far, so good, right? Then they made a sale. Okay, they sold 120 units. Now at this point, they only have 1 lot of inventory, right? They only had what they started with. They're going to purchase some more inventory on July 10th, but right now it's July 5th. So the only inventory that they could use is that $21 inventory. So it must have come out of that lot. So they sold 120 units at $21 each, which equals that. So how many units do they have left over? They started with 150 and they just sold 120. 30, right? That's what we see over here now. They have 30 units remaining. So it's 150 minus 120 equals 30. They had a cost of $21 each, and we can see the cost of that in inventory. Okay. Then they buy some more inventory. They buy 225 units at $27 each. Notice it's in the cost of goods purchased column, right? And this is the total cost. So now this is the part that might seem different than what you would expect. What we have to do to keep track of these separate lots is we just copy this down here. So these 30 units just get moved down here. It's the same $21, same total. And then we add this new lot that we just purchased here. We don't mix them together. We want to keep track of these 2 lots separately. Okay? Move whatever was remaining down, and then you add the new lot right underneath it. Any questions on that part? Okay, then we make a sale. We sell 180 units. Since we're doing specific identification, we have to know which exact lots these came out of, right? So in this case, 20 came out of the first lot, which remember, there had been 30 remaining. Now we have 10 remaining in that first lot at the cost of $21 each. And we sold 160 out of the second lot, giving us 65 remaining at $27 each. So it makes sense. It's just the way it's laid out takes a little getting used to. Any questions so far? Then we make another purchase. So now we have a third lot, and that gets listed underneath the other two. Right? So these two just get copied down here, and we add the new lot. Now we can add up all of the cost of the inventory we purchased, all the cost of the goods that we sold, and then if we added these together, that would give us our ending inventory cost. So that's how specific identification, FIFO and LIFO work in this perpetual inventory approach. Any questions on that? Well, let's look at the next one. Again, sales minus cost of goods sold gives you your gross profit. Let's look at FIFO. And we'll see it looks the same. The only difference is going to be how some of the numbers come out. In fact, it starts out exactly the same because there was only one lot, right? When you have only one lot, it doesn't matter what method you're dealing with, the cost is going to be the same. It's only when you have multiple lots that it makes a difference. So when we start off, again, we have only this one lot. We sell 120 units out of that one lot, so we still have 30 units remaining at $21 each. That part's exactly the same. We make a purchase. This part is the same too. We just carry down the 30 units. We add the new ones that we just bought. But here, when we make our first sale and we have multiple lots, this is where things are a little different. Because we're doing FIFO, this sale of 180 units is going to first clear out the oldest lot, right? First in, first out. So we're going to use up all 30 of those as part of the cost of that sale. And the other 150 units are going to have to come out of the second lot, which had 225. So that means there's 75 units remaining in that second lot. And we see the first lot's completely gone at that point. Then we make another purchase. We carry down these 75 units. We add the new units that we purchased here. Again, you could add those together to get the total cost of your ending inventory. Add up your total purchases and your total cost of goods sold. So using FIFO, the numbers will come out differently, but you see it's fairly similar to what we just did with specific identification. All right. Any questions on this one? Again, we could look at the profit. And then we get to LIFO. So LIFO again is going to be similar. Starts off the same because there's only one lot. When we make a sale, it comes out of that lot, right? This one lot that we have here at the beginning is our first lot and our last lot, right? So again, it doesn't matter if you're doing FIFO or LIFO at that point. But once we make another purchase, now we've got two lots. And then when we make a sale, that's where we have to figure out, okay, are we taking the costs out of the first lot for FIFO, or now that we're doing LIFO, the cost would come out of the second lot. So these 180 units that we sold are all coming out of the second lot, leaving 45 remaining. And nothing came out of the first lot, so we just copy it down. When we make a purchase, copy those two down, add the new purchase in there. And same basic steps. We just come up with different numbers because we're basing it on last inventory, not the first. Right? Again, we can take our cost of goods sold out, get our final profit. Now, the weighted average method is a little bit different, kind of looks similar. But every time you make a new purchase, you have to recalculate your average. You start out the same, once again, because if you have only one lot, the average cost is whatever is the cost for that lot, right? And it's only when you have multiple lots at different costs that your average starts to change. So we start out the same, 150 units, we sell 120, that gives us 30 remaining. Here's where things change. We buy another 225 units at a cost of $27. What we have to do now is take the total cost that we had before the purchase, add it to the cost of the purchase to get our new total cost. Right, so this is $630 plus the $6,075. It's a $6,705. That's our total cost of both lots combined. Then we divide that by the total units. We had 30 from the first lot that were remaining. We just bought 225, so we add that together, that's 255 units. And you have to do it in that order. You figure out your total cost, total number of units, then just divide. Take the total cost, divide by the total number of units, and you get your weighted average. So then when you make a sale, these 180 units are at that weighted average cost. And since we had 255 units before and we just sold 180, we have 75 remaining, also at that same weighted average cost. So 75 times that average gets us our total ending inventory. Then we make another purchase at a different cost. We bought these 210 units at $33 each with this total cost. What did we have to do before? We should take our previous cost, this $1,972, add the new cost for the new purchase to get a total cost, and then divide by what? Total number of units, right? We had 75, we just bought 210 more, so that's 285. The total cost divided by total number of units gets us a new weighted average. So with this weighted average method, you're not having to keep track of multiple lots at a time, because every time you make a new purchase, you just calculate a new average. That's why in the other methods, we had multiple lines together, right? Because we had multiple lots. With this weighted average, you don't see that. You don't see multiple lots on separate lots. It's averaged out with every new purchase. We will practice this later, okay? Because it is, a lot of steps. And you have to go, just have to make sure you're following the process correctly. Any questions or comments? All right, well, we're getting through this material pretty quickly. Again, subtract cost of goods sold from sales, you get your gross profit. We can see the comparison. This is another situation where the costs were going up, right? So when the costs of our inventory are going up over time, FIFO is going to give you the lowest cost and highest profit. LIFO is going to give you highest cost, lowest profit. And the weighted average and specific identification will be somewhere in the middle. So why would a company ever choose to use perpetual LIFO? Why would you do that? Let's think about that. You know, with perpetual, you always have an updated amount of your inventory cost. And if it's an automated system that's doing it, it's not difficult to do that. Manually, it could be difficult. You had to track it. Every time you made a sale, you had to figure out the cost. That would be difficult. But if it's automated, it's pretty simple. But why would you go with LIFO over FIFO? Why might a company do that?
Maybe you buy a lot of stuff that's cheap that sells really fast.
And so then how would LIFO be advantageous then in that case?
Like you said, the news inventory is getting sold a lot, so.
Okay. So if it's getting sold quickly, in that, let's imagine the opposite were true. Let's say your inventory was not selling very quickly. Maybe you stocked a lot of inventory, like you had a lot of specialized stuff that you know it's going to sit around before the right buyer comes in. So it might be sitting there 6 months or a year. Go with FIFO. And if costs are going up, that's going to give you the lowest cost, which you're going to want if you want to look more profitable, right? And if you go with LIFO in that situation where costs are going up, that's going to give you the highest cost, the lowest income tax amount that you have to pay, right? But what if costs are going down? Then the opposite would be true. You get the biggest write-off with FIFO, and you'd be more profitable with LIFO. So much depends on what's happening with prices. Are they going up or are they going down from your suppliers? And what your strategy is. And how quickly the inventory turns over. That would be a consideration. Should the order in which the items are actually sold determine which costs are used to offset the revenues? In other words, why don't we just always use specific identification? Why do we give accountants the ability, even though they sold this unit that cost $7, to say, no, I'm using LIFO, so I'm going to say it costs $9? Why do we do that? Why do we give them that option? If we said that all companies have to use specific identification, you always have to know exactly what lot each unit came out of, that puts a burden on them. How do they track that? Right? If you're getting deliveries from your suppliers all the time and the cost to you is changing, how do you keep track of what lot that particular unit came out of and what the cost would be, right? It could just be too challenging to do that. Now, maybe in the future, when we have sophisticated enough technology that it does that for you, maybe that makes sense. But requiring companies to do that today would probably be too much of a burden. Okay, finally, an exercise. Let's see if we can apply some of what we learned here. So we'll do exercise number 5. Right. Okay, I'm not going to make you listen to this again, but as we just discussed, if there's a mistake in cost of goods sold, it throws off your net income and your inventory for at least this year and the following year, and then it gets corrected. But as I mentioned, if you found a mistake, you'd want to go ahead and fix it as soon as possible, right? Even though it'll work itself out eventually, you still don't want to have incorrect information out there, especially if it's available to the public, right? Because they might be making investment decisions based on your financial statements, and if they're wrong, they would have a right to be upset about that. They could even sue the company. Okay, so again, now we are going to talk about ratios. In chapter 9, the accounts receivable turnover ratio, you might remember, was pretty simple. Well, same thing with our inventory turnover ratio. It's pretty simple. You take your cost of goods sold, divide it by your average inventory. And just like before, you want this number to be as high as possible, because what that means is you have a low amount of inventory and a high amount of sales. That gives you a bigger number. You have a lot of inventory and a low amount of sales, and you're going to have a smaller number. That's not good. How do you think we calculate average inventory? How did we do averages back in chapter 9 with accounts receivable?
You add all the inventory divided by the number of lots.
Say it one more time, Louis.
You add all the inventory and divided by the number of lots.
Well, that's how we get the weighted average cost here. But thinking back, like what we did with the accounts receivable turnover ratio, remember we had to take the beginning accounts receivable from the beginning of the period plus the ending accounts receivable from the end of the period, and then we divided that by 2. So that's what we'll do here with inventory. Beginning inventory plus ending inventory, add them, plus, I already said, we add them together, and then we divide by 2. Okay, so that's how we get the average inventory. And then we divide that into cost of goods sold, and that's our inventory turnover ratio. Now, last chapter, we did have number of days sales and accounts receivable. Here we have number of days sales and inventory. It's similar. And in fact, you could apply the same formula, but the correct way to do it here is you take the average inventory, that's what we had calculated for the turnover ratio, and you divide it by average daily cost of goods sold. To get that number, take your cost of goods sold and divide it by 365, because that's the number of days there are in a year. That is your average daily cost of goods sold. Divide that into average inventory, and you get your number of days sales and inventory. If you wanted to do it similarly to how we did it with accounts receivable, you could take 365, divide it by your inventory turnover ratio. That's easier. From what I found, you're usually off by about 1% if you do it that way. So we should probably do it the right way and get more accurate numbers. So these are the 2 ratios that we will be using here. I guess we can practice that now. We have a little time. So here we've got a balance sheet and an income statement for year 1 and for year 2. And let's start with the inventory turnover ratio. So the formula was cost of goods sold divided by average inventory. Okay, if we're trying to do that for year 1, we would take cost of goods sold, and we'd have to divide that by average inventory, which means we take our beginning inventory plus our ending inventory, and then divide that by 2. That's all we have to do. Then if we're going to do number of days sales and inventory, first we need average daily cost of goods sold. We take cost of goods sold, divide by 365. Once we have that number, we divide that into average inventory. Okay, so here it's calculated for us. So cost of goods sold was 7,200. Right, we see that here. Average inventory comes out to 6,053 for year one. Again, that would have been the beginning inventory plus the ending inventory divided by 2. Right there. And we get 1.19. If we do the same thing for the next year, it goes to 0.84. So our inventory turnover ratio has gone down. So from what I said, is that a good thing or a bad thing? If our inventory turnover ratio goes down, it's good or bad? It's bad, right? You want it to go up. And just like with the AR turnover ratios from last chapter, there's an inverse relationship between the turnover and the number of days sales. Number of days sales, you want to go smaller. But we can assume our turnover ratio is getting smaller, our number of days sales is going to get bigger, which is also bad. So how do we calculate that? Well, the same average inventory we had from the last calculation. Divide that by average daily cost of goods sold, which is just your cost of goods sold divided by 365. So here we see cost of goods sold of 7,200 divided by 365. Comes out to 19.73. When that gets divided into average inventory, number of days sales and inventory. So what this is saying, we have enough inventory to cover 306 days worth of sales. Why would you need that much inventory just sitting around, not getting sold? Right? That means you've got stuff you've already made or purchased that your salespeople aren't going to sell for about 10 months. You're having to store it, you're having to insure it, you have to pay for it. So that's generally not good. Now, if it's a car dealership, maybe that makes sense. Maybe some of their cars they keep around a long time, I don't know. But in general, most products, you want them to move faster than that. Maybe if it's Boeing selling airplanes, that's okay. I don't know. But I think for most companies, you definitely want a shorter number of days sales and inventory. And look, the next year it gets worse. It's now more than a year. Your inventory is sitting around more than a year before it gets sold. So again, you want number of days sales to be going down, not up. And you want your turnover ratio to be going up, not down. All right? What questions do y'all have? Well, I guess we'll go on to a problem then, number 16.